Hello, everyone, and welcome back to the PetroNerds podcast. My name is Trisha Curtis. I am the CEO of PetroNerds and the host of the PetroNerds podcast. This is episode 144 of the PetroNerds podcast. I am super pumped and psyched to be with you here today. Today is Tuesday, November 4th, 2025. It is my dog Axel's birthday today. But today we are sitting at $60.43 for WTI, and we have a lot of ground to cover in this introduction to give you a recap and roundup of the market. The PetroNerds podcast is ripping. So right now you are one of thousands of listeners and watchers on YouTube. That is because I did this op-ed for the Daily Caller on China, and winning against China means winning on energy. I was on the Steve Gruber show with from Real America's Voice, and that has since driven, which was great, by the way. I'll put a link in the show notes to that 10 to 12 minute episode, which was awesome with Steve Gruber. So we talked about energy, we talked about LNG, we talked about rising electricity parts, and particularly competing with China. So that's driven a lot of traction. But with all that, folks, at $60.43, we've got a lot of ground to cover because over the weekend we had an OPEC meeting, and OPEC increased output, and then they said, "Hey, hold on, we're actually not going to increase output we're going to pause this increase for the first few months of the year." So we had oil price around 60, they popped to almost 62, they've since come back down into the 60 range. Now, all this is on the back of the China and the China Trump meeting, or the Xi Trump meeting that happened last week. So this podcast that you're going to listen to today is going to give you a massive amount of content, and it is a slide deck. So if you're watching it, you can actually see the slides, but it's a little different from my keynotes that I give that where I'm doing a fireside chat that you've been hearing. This one I did it the Forward Chamber of Commerce. It is a ton of intel and a lot of deep diving in terms of how I see the market and where things are at. So this was with the Forward Chamber of Commerce. It was recorded on September 17th, 2025. I think you're going to absolutely love it. The reviews are really fantastic. I can't thank the Fort Worth Chamber enough for having me come in. I was so impressed with the audience, and they weren't necessarily oil and gas folks. They were folks that were very interested in economics and business and energy. And so it was just a super treat to be able to present to them and talk with them. And they had really great questions, which you'll hear in this podcast. But with all that, this $60.43 we're seeing right now, 64.31. So OPEC had the meeting over the weekend. They said they were going to increase output by 137,000 barrels per day. And then they came out afterward and said, "Hey, we're not going to increase that output. We're going to pause these increases for the first quarter of next year." Now, that's warranted because of the pressure we've seen in oil prices and the concerns, I think, within the economy and just anxieties all around. But it's confusing in terms of what they're seeing and what they're actually thinking and what that actually means for total production figures. Really importantly, that if you're looking at month over month figures, total output on a liquids basis for total outputs on liquids basis for Saudi Arabia went up nearly 500,000 barrels a day, and they are north of they're 11,400,000 barrels per day, or 11.4 million for total liquids output as of June, which means they've really pressed up. So that is why we're seeing so much. That's why we're seeing pressure on prices, and that's why we're seeing so many barrels actually on the water. But we will come back to that because I want to get into the recapping of what's happened with China, what's happened with the Trump and Xi meeting. So a few weeks ago, on October 8th, we actually had China come out with their rare earth export restrictions. The 2 days later, that Friday, we had Trump come out and say, he did his Truth Social post, and that's what drove oil prices down. I think it was October 11th, that Friday. Drove oil prices down to 57, and then the market recovered that next Monday because there was going to be some rapprochement between the U.S. and China. There was a cooling of the rhetoric, and then oil prices did not recover. Oil prices went back up to $62 a barrel when the U.S., the EU, and came together at the same time and slapped sanctions on the U.S. slapped sanctions on Russian crude, on Rosneft and Lukoil, and the EU slapped sanctions on Chinese teapot refineries taking Russian crude oil. And then also at the same time, India said they wanted lower tariffs and they were willing to stop taking Russian crude oil. As of right now, or as of the past month, India has actually been increasing their uptake of Russian crude oil. They say it's 1.4 million barrels a day, almost 1.5 million barrels a day for October. I think it's probably way closer to 2 million barrels per day. But the point is they've ramped up those imports so they can not take them in this next month. So all that happened at once. That's what drove prices to 62. And then we've since had this cooling off. And obviously what happened over the weekend was a lot of confusion within OPEC. And then there's giving some market signals, right, of what's actually happening within the market. But what happened last week was we had the Fed meeting last week, and we had the Trump Xi meeting, and then Trump came back to the U.S. So several things were happening up to the run of this. You've had in the last several weeks, you've heard a lot of rhetoric on the taco trade and Trump not being, we have no hawks left in Washington. And this is just really, really not true. I mean, I think, this administration has done more to push back on China than any administration in 40 years on actual trade. And tariffs have a lot to do with that, right? Because what happened basically on this week when Trump and Xi met was in advance of this, Trump did a lot of talking on Air Force One and he said we might sell them NVIDIA Blackwell chips. Obviously, we didn't do that. And so really it was his cabinet actually around him. It was Bessent and it was Rubio and all these others and Lutnick all around him that said, no, we're not selling the Blackwell chips. And then we didn't, right? They didn't even talk about that. But what they did agree to was a 10% reduction in fentanyl tariffs. So China got a 10% reduction in fentanyl tariffs. So I think they're at 47% for the tariff rate, which is still very, very high. And China agreed to give a 1-year exemption on this rare earth export restriction. This super, it was concentrated, it was 0.01% of rare earth. If you have a Chinese rare earth, whether it's raw or refined, that they were going to require you to have a license for that. So that's what happened was basically we got a 1-year exemption for that and they get a 10% reduction in fentanyl tariffs. So it was a not much going on. And I think the problem that people aren't really reading into this is the incredible geopolitical risk is that people are not really appreciating that this is a signal, right? This is telling you the direction of travel that the U.S. and China are going, which is a confrontational path, which is, China is saying we're agreeing to live to sort of fight another day and we'll kick this out a little bit, but this is our card and we're going to continue to play it. And the U.S. is saying, we know you're going to play it and we're trying to beef up things on our own. So I don't think the market reacted quite like they should have. It didn't buoy. It did like ahead of the meeting, the stock market was going crazy and people were getting really excited. That was partly why oil prices were up as well. But it was all for the wrong reasons. And NVIDIA was popping as well. And then wow, in addition to all that, which I don't think the market kind of read, and now the market is probably reading this as well as, we're in the 34th day of the government shutdown and we have layoffs. And so the market's starting to feed on this. And then if you don't get a perfect earnings call from a chip company or a tech company, you have some problems. So the stock market is actually down today on November 5th or November 4th. So we're seeing all this kind of collectivize together. But the Fed also met last week and I listened to that speech over the weekend. So Jerome Powell spoke last Wednesday. They had a Fed meeting. They agreed to lower interest rates a quarter basis point. So that was widely expected, right? Some folks were thinking, oh, we might have a half basis point. You clearly have Brainer and some others advocating for that. They didn't lower a half basis point. They lowered a quarter. And then importantly, I thought Jerome Powell seemed a little bit on edge, and that makes sense, right? He's being pressured, he's being ripped on by the Trump administration. While he was actually Trump in South Korea was ripping on Jerome Powell in his speech after he landed. Or sorry, after he landed actually in South Korea. So so you got this pressure, but Jerome Powell comes out and he says, hey, basically the meeting in December is live. We have not guaranteed that we're going to have a rate cut. And so that spooked the market a little and you got some cautiousness right there. And the reason of that is because we do have inflation, right? We had a 3% inflation read. I am tracking this inflation. And so when I chart unemployment and I chart, which we don't have a read for that because we have a government shutdown, but when I track inflation and when I track oil prices and when I track all this stuff, and like we actually have a read up and we've been ticking up with inflation in the last several months. Now, part of this is that everyone's saying, okay, we have not had this pass through from tariffs and we haven't. And the reason why we haven't seen so much of that is because companies know that they're getting pushback from their consumers. And I think we're starting to really see that. And that's what's getting people like caution, right? Is that the high end consumer is spending, the lower income consumer is not. I know I've been talking about this for a couple of years with clients and on the podcast, but you're really starting to see this resonate, right? Where Chipotle, they're starting to see a drop in sales. Now, they say other companies are doing well. And that means that in a tough environment, you have to be really, really good. I know this is a small business. You have to be really, really great when things are really hard so that people pay you. And so for Chipotle, if you're not really great and you've got it's a minimum of $12 for a burrito bowl, you have to compete pretty hard to get people in. And so inflation on that side has been sticky for a long time and it's really just pressuring the consumer. You're hearing that at Chipotle, you're hearing that at IHOP and Cracker Barrel. Super important to point out, if you guys have not been to an IHOP lately or go to DoorDash and just order your family a meal and you will realize how expensive it is to get an okay, somewhat crappy meal. I love their French toast, but their bacon sucks, right? Their eggs aren't cooked. So it's expensive to feed your family. And so this is why these guys are seeing pressure is because the alternative is we'll just cook at home, right? Because it's just so expensive to go out. And so you're starting to see that. Add to that and couple that in with the CNBC just has an article up right now that says AI washing and the massive layoffs hitting the economy. You were hearing layoffs from UPS, from Target, from Amazon. You're hearing across the board. These are and Microsoft, like across the board. It's something like 60,000 just we've had recently, and these are white collar job layoffs. Now, a couple years ago, we were hearing about this too, but the reality was that a couple years ago, you could go get another job, and it was much easier to move around, and people were quitting, and the quit rate was high because the hiring rate was high. You don't have that same rate now, so people are losing their jobs, and it's taking them a long time to get another job. That all being said, the unemployment rate looks pretty okay. And so there's a lot going on behind the scenes underneath this data where we have low immigration, very, very low immigration now. And we are seeing some layoffs, but I think on the working side, which is really matters for inflation, where people are living paycheck to paycheck, people have jobs, but it's tough, right? And I've been talking about this for a long time, but it's tough to make ends meet. And that's where some things where you see a little bit folks being furloughed for the government shutdown, we can start feeling the pains of this a little bit more as we get over a month into it, because now folks who have been furloughed are a month without a paycheck. That doesn't mean they're not going to get back pay, but it means if they're living paycheck to paycheck, they're now at that point where, hey, crap, we got to go buy groceries and stuff and we don't have the money. So I think all those are really, really serious to think about. And there's serious to think about just in the context of the economy, the context in the stock market. With the government shutdown in 34 days, it's going to be the longest shutdown we've ever had soon. And so it looks like there's kind of no end in sight. And part of that is because you definitely have both on the left and right. There's no incentive to do this. And on the left, you have folks like Mandami, who's not even elected, who apparently is leading voices, and AOC on the far left. And I'm getting this from Bloomberg surveillance, from people who are kind of left of center on their analysis, saying that, the far left is ones who's leading the voices on the left side to say, let's not reopen until we get something we want. And so what you got is a stalemate that's going to really start hurting the consumer. We are hearing on the FAA side, where air traffic control, we saw last week on Friday, where we saw New York's airport actually get shut down. That's a really big deal because flight traffic control, we were having these problems way before we had this government shutdown, but you can see where it's getting compounded now. So we will see. I'm headed to London tomorrow, actually, so we will see how that goes. But when we bring this all home and we try to talk about oil prices and what this means to the market, you can start seeing how again, we don't have a drop off in demand. I'm not seeing that in the weekly demand figures. People still have jobs. And that's really important to point out. Is if you have less immigration and you still have folks having jobs, yes, people are having jobs. They're just not necessarily paid that well, or may not have something that they want. But all this, we haven't stopped demanding crude oil, and importantly, China is stockpiling like crazy. So we are stockpiling. We're adding to the strategic petroleum reserve, but it's not by very much. It's incremental, right? It's incremental growth. We could be adding more, especially when prices are in the 50s. I think you heard Chris Wright signaling and saying that. But if we were to add 1 million barrels a week, that would be helpful, right? A full 1 million barrels or 1.5 a week, we could really start giving some support on oil prices. But at 64 for Brent, really importantly, so we'll come back to oil prices and the economy a little bit, but Henry Hub is at $4 and 4.312. So $4.30 for Henry Hub natural gas. That's a big, big uptick. I had to double take and look at this because we had a massive pop from last week to this week. And now the reasons for this are multifold, right? Toby Rice was on at ADIPEC. There's a bunch of people. If you're watching late night stock market, there's a big conference in the Middle East where everyone's at. And everyone's talking about power, and everyone's talking about AI, and everyone's talking about power generation. And everyone on today is election day, and everybody's talking about electricity prices. I mean, it's really, really serious where rising electricity prices are absolutely hitting people so hard. So natural gas price spike is really serious because we have this demand for AI, and we have just demand for regular manufacturing, just overall demand we haven't built out. And most importantly, what's driving this price spike right now is that demand pressure, but it's really weather or traders thinking that we're going to have a cold snap. So they probably go out in New York and see that we're going to have a cold snap, and they're trading accordingly, but also a pop in LNG exports. And so Toby Rice said as high as 19 BCF a day is what we were exporting. If you go to EIA, I had a double take on this because the monthly data is not showing this. The monthly data is still showing we're about 15 BCF a day for exports as of August. But the current exports, apparently, I've heard from 17 BCF a day to 19. Either way, that's 2 to 4 BCF a day increase in exports. So that's significant, right? That could help prop up natural gas prices. But if you look at gross withdrawals, which dropped last Friday, holy smokes, we're nearly 132 billion cubic feet per day of gross withdrawals. That's production, total production coming out. And for oil, we're we're 13.74 million barrels per day. So we had the month prior, excuse me, was revised up to 13.7 million barrels per day. We upticked a little bit. Now, this is incremental growth. And it's important to look at this because I am headed to London tomorrow and I'll be going to Oxford University and I'll be giving a talk on U.S. shale at the Oxford Institute for Energy Studies at Oxford University. And I'll be talking about U.S. shale and what's actually happening. And everyone's going to ask, what is driving this, right? What is doing this? And increasingly, last night I was listening to the news and people are saying, look, U.S. shale is going to roll over. Well, everybody's been saying U.S. shale is going to roll over for this past year, including the oil patch, including the U.S. shale industry. And you're not having massive growth, but you're also not having massive deterioration. And I think it's really, really important to point that out is that, you look at the rig count, that is, it closely tracks with oil prices. You can chart the rig count and oil prices, and they fall in line really, really tightly. But you are doing so much more with less with those rigs. You're drilling longer laterals. Importantly, you are fracking. You have more intense fracks, right, where you are pumping more fluid and more sand down those wells, and you're recovering not the same output, but you are able to go into lesser acreage and still get plenty of production back. And really, really importantly, is it is still profitable. And I think that's a disconnect what people are seeing around the world and looking at the oil patches, that they cannot be making money at $60 oil. They are making money. It's not the same returns that they were making before, but they are making money. And I think that's really important, is that because completion costs have really been pressured. So service companies have really, really been pressured. And so they are taking hit on this. And so you're seeing completion costs come down to levels that we haven't seen really since COVID. So all that's really important to think about in the context of 13.74 million barrels a day. We have a slug of production on the global oil market. And so the other thing that you hear is about, well, how much excess supply? We clearly have excess supply. I mean, it ranges from a few 100,000 barrels a day to millions a barrel a day of excess supply. When I'm looking at this and I'm looking at oil on the ground, in stockpiles in the U.S., SPR, Cushing, everything doesn't look completely out of whack. The oil on the water does seem a bit out of whack. And so everyone's likening this to what, we're going to have very, very low prices because we have the oil in the water. And I think that's being subdued. And part of that, why that's being subdued, is because of what's going on with India and what's going on with Russia. Now, Russia, the war in Ukraine is still ongoing. You are not hearing about it because overwhelmingly now the stock market's freaking out about AI and growth concerns and job layoffs. And are we going to have a cooling and overvaluation? But last week was the Fed meeting, and last week was the Trump Xi meeting, which, as I kind of said, is kind of a nothing burger and really points to more conflict, not less. But the real important thing from all this is that I think U.S. oil companies are not squarely appreciating geopolitical risk. I do not think geopolitical risk is being priced into oil. I do think oil is still at least $5 oversold, probably should be closer to 70 given all the geopolitical risk. And that is because the war in Ukraine is still ongoing. Russia is still continuing it. And just a few weeks ago, you had Trump saying they were going to have the meeting in Budapest. He was going to meet with Putin, and maybe they were going to have a trilateral, and Zelensky was going to come as well. And all that got thrown out completely out, baby out with the bathwater a couple weeks ago because they said we weren't making progress and we're not going to have the meeting. So no meeting with Putin. And then you have the war still continuing, right? You're having Ukraine is attacking inside Russia. They're attacking Russian infrastructure. They're going after oil infrastructure. And so they're attacking more infrastructure and processing and refining. They're not necessarily attacking upstream, but you are hearing some conflicting information that Russia may be having trouble increasing output or maintaining output. I am not certain of that, it's hard to validate that. But that's a harder circle to square because refining doesn't equate to production. So we're definitely hearing on the ground, and folks anecdotal information within Russia is that refining is being hit, and there's pressure at the pump. There are certain areas that can't actually get refined products. So that's real. But then you're hearing that, we're starting to hear, okay, is Russian production in the production level getting impacted? And I have nothing to validate that. So I put a big question mark on that. But in terms of the actual sanctions, the reason why folks are, if you're slightly bullish on oil, you might be, is because that, it's not for the U.S. We didn't just sanction, vessels or something. We sanctioned Rosneft and Lukoil, the companies. Okay. And so that's a bigger deal if that gets enforced than just sanctioning the barrels. Then if Europe does actually sanction these teapot refineries and holds that to where they can't take this crude, then you start seeing some real restrictions. But the reality is that China is going to continue to take this crude oil. Okay, so we think that they're going to continue to take this crude oil. The question is India not going to take it? And that's 2 million barrels a day that they will have to supplant. And there's plenty of oil in the water that they can take. So lots of question marks there. I still think even with all of that, even with the layoffs, even with all these concerns, even with stock market dipping a little bit today, I still think oil is too low, right? It's too low given the current unemployment that we have, given the current economy that we have. Unless I see massive unemployment and I start seeing people driving less, I still think oil is too low. We also, as I mentioned, we have a lot of supply on the market from the Saudis of their 11.4 million barrels a day in June, which is probably closer to, probably nearing closer, I'm guessing, high 11s, which also puts a lot of cold water on that theory that we didn't have OPEC spare capacity. So just something to think about there. Okay, so that is your kind of roundup and recap of the market right now. This podcast, this talk is basically the talk I gave. The Fort Worth Chamber of Commerce had me come in just for this presentation, and it was a sold out crowd. It was a sold out room. It was really awesome. Really want to thank Ryan Haggerty for having me come in and do this. It was an honor to do it. Can't wait to go back. But this is a soup to nuts. There's nothing we don't cover. I spend a lot of time talking about oil prices, the state of the market, geopolitics, China, Russia, the nuances of everything in between there, talking about LNG exports. So soup to nuts, I get into the weeds. This is a podcast you're going to want to listen to, want to share. If you have not listened to or tuned into the Daily Caller, the article I did, I'll put this in the show notes. This is the winning against China means winning on energy. This has had a lot of traction, folks. So please take a look at it, take a read, and share it with folks. I was also on the Steve Gruber show on Real America's Voice. My folks actually woke up at 4 a.m. to watch this, so that was really cool. And that was fun. He was great. It's a 10-minute episode. I can put the link in the show notes as well. And we talk about everything from China to LNG exports to rising electricity prices in the U.S. And I think it's so important that we talk about that, folks, and so important as an industry to pay attention to that. I just charted and just took a look at the data right now. We're still about 19 to 20 cents kilowatt hour in the U.S. for average electricity prices. Importantly, we are seeing a direct correlation with electricity prices and that kind of pause on the uptick that is correlating directly with coal and wind and solar. So when wind and solar kind of pause and coal also pauses its decommissioning, we see prices pause. So prices go up when you decommission that wind and solar, and literally you can see this on a month-over-month basis. And when you add the wind and solar, when you stop adding wind and solar, and when you uptick that coal a little bit, prices come down. And so that is because there's a lot of other factors at play, but that is because this wind and solar is so expensive and because the demand on the grid is rising, and coal gives you that reliable baseload backstop. And I think it's so important when we think about natural gas, folks, is that we're adding all this demand of natural gas into the electricity pool. We absolutely need it. AI needs it. Everybody needs this natural gas. But when you have those price spikes, the utility companies are not going to say, oh, we'll just eat that. They're going to take the $18 an MCF that they're charging you and me and everyone, and they're going to increase that. And so who's going to get blamed for these price spikes? It is not going to be AI, and it's not, well, maybe a little bit, but it's not going to be the utility companies. They are going to blame oil and gas and traditional fuels, which we should not be blaming, because we have more oil and natural gas in this country than any nation on earth. Full stop. We have more than that. 132 BCF a day is more than double what Russia's producing, the second largest producer. That 13.74 million barrels per day of crude oil production is almost 4 million barrels a day more than Saudi and Russia, the two second largest producers. So we have a lot of that. We have a lot of oil and gas production, and we have more coal reserves than even China does. So we're an energy-rich nation, and we should not be having the problem of folks disconnecting from their utilities, which is happening right now. So with that, folks, thank you guys so much for listening, and I'll talk to you soon. Bye.
Welcome, y'all. Appreciate you being here. If I've not had a chance to introduce myself, my name is Ryan Haggerty. I'm with RHR Oil and Gas, a small independent operating company with assets in the Permian Basin. Also own RHR Minerals, in which I have the privilege of working with partners and managing minerals really all over the country, essentially. But thank you for being here. It's a privilege to serve on the board of the Chamber of Commerce and also be a co-chair of the Energy Council, along with John Balance with Whitley Penn. This is the Energy Council is about a year old, and this is kind of a special edition because of our welcome guest, and so we really wanted to open the doors to be able to hear from Trisha. So thank y'all again for being here. I was thinking about this today in my office. I have two two hats, literally, not metaphorically. Two hats when the Make America Great Again hat became a thing. One says, make oil $80 again. And that hat came after the crash of 2014 into 2015 when prices dropped by 70%. That hat has now been replaced by make oil $0 again when during COVID prices actually went negative. That's my world that I live in, and the gray hairs that are slowly forming on my head. And so it is nice to have someone like Trisha, a macroeconomist who I can put on speed dial so that when those moments happen, I can call and say, what are we doing and what is going on? So glad to have Trisha Curtis here. So let me introduce Trisha. Trisha Curtis is the president and CEO of PetroNerds. She is a very sharp macroeconomist who translates rigs, rates, and geopolitics into plain English. She masterfully blends on-the-ground shale analysis with global market and policy insights, and she hosts the PetroNerds podcast. Before PetroNerds, Trisha led upstream and midstream research at the Energy Policy Research Foundation, and later served as manager of strategy and analytics at Anschutz Exploration. Her work centers on U.S. shale performance, OPEC dynamics, and the particular impacts of regulation and geopolitics on investments and operations. She's advised operators, investors, and policymakers across the U.S. and abroad, and her insights on oil and gas markets are timely as they are practical. And so we are glad that she is here, hailing in from Denver. We had a dinner last night in which we welcomed her and have tried to convince her to move to Fort Worth, and I'm still working on that. But without further ado, Trisha, thank you for being here. Appreciate
awesome. Okay, well, I love rooms like this. So this is nice and intimate and cozy. I am recording this, but feel free if you want to do Chatham House rules. You can ask questions, and I will delete your question or delete you or whatever you want, or we'll leave it open. But I am recording this. I gave a keynote talk at Whitley Penn today without slides, and so it was like an hour-long fireside chat, which was really fun. And so I've had my brain is still going, and I have a lot of slides. I have too many, but I'm a more is more kind of person, and so you guys are Texans, so this should work for you just fine. So we have a lot of slides, and I really appreciate the introduction. I'm really, really happy to be here and love that you guys are here to actually listen. So I'm going to do a couple things, and that is try to speak both slow and fast at the same time. Because we have a lot of ground to cover, and there's a lot happening in the economy and the oil market. And even if you are not directly exposed to oil and gas and energy, you are directly exposed. Even if that is not your day-to-day business, it is driving the economy and vice versa. And something that I do pride myself in, but I care a lot about, is that I am fortunate that I work with operators and private folks all the way to the Pentagon and national security. And so in the slug of all that in between, I get to cover a lot of different stuff, and I get to work with different companies. And that is where I think when you use oil as sort of a tool to understand what's happening in the economy and vice versa, it can really tell you a lot. So we're going to hit on some of the big highlights. It's not like there has been anything happening in the news today or the past few weeks, so it'll be fast, it'll be easy. But I put this as trying to provide some clarity in this midst of volatility. There was a very good panel at the end of the conference today at Whitley Penn where everybody was talking, it was a lot of private equity, and they're talking about oil prices and the macro, and it was interesting because I asked them about the groupthink we have in the industry, which we tend to sort of be macro bull. The oil and gas industry tends to be macro bulls, that oil prices are just going to go up. I don't believe that, and haven't really ever, and I grew up around this business. And I think some of my production stuff, you'll get into why. So big things I want to talk about, if we get some big takeaways today, is really what's driving oil prices. Why are we sitting at $64 a barrel? The last I checked, so it could have moved, I apologize. We were at $65 yesterday, we're at $64 a barrel today, but why are we there? What is driving this? So on that front, we'll talk about supply and U.S. shale productivity and sort of this peak shale. I really want to hone in on that a little bit. So at the end, we'll have plenty of stuff on U.S. shale activity. But really, the drivers, and I'm going to give you the upfront notes now of what's actually happening and the answers. I mean, we have a lot of supply in the market. We have okay demand. We do not have a cratering off the cliff recession happening, but we have a lot of concerns about that we are going to recession. We have a lot of concerns that lots of folks within this country are actually already in recession, and we don't have a rip-roaring like demand story. There's nowhere in the world, not Europe, not China, not the US, where we're driving demand. And actually, if you go on CNBC right now and you click oil, you will see that the headline says oil down, buck because of US demand concerns. And it was because diesel demand came off a smidgen. And so when you see that, that's like a week over week. Everything moves week over week. But if we have a month or two where diesel demand is starting to get soft, and quite frankly, diesel demand has actually been soft. It's not been negative or down. It's just been kind of soft, which has been telling us that we're not ripping. And so all this, if you look at all the data points, whether you're looking at trucking or rail or all the stuff in China, nothing's telling you we have a demand growth story going up. So with that backdrop of nerding out on the data, then you start looking at the supply side and you say the U.S. is producing 13.6 million barrels per day. And that is a lot of crude oil. That is more than any nation on earth is producing and more than any nation on earth has ever produced. So every month we hit a new high, we break our own record and we break every global record, and we're just killing it on production. And this is why I'm hesitant to ever say, you can just go up high and stay there for prices, because we're very good at producing this. And it's not just the US that's producing a lot of oil. We have every nation outside of OPEC is producing more oil. Canada, Brazil, Guyana, list the country, if they produce oil, the production is up. And I'll show you the OPEC figures as well, and we can talk about OPEC dynamics and what's going on there and why they have added barrels onto the market. So we have plenty of supply in the market. We don't have this growing demand side. But all that being said, and knowing that I'm not like this mega bull on oil prices, oil prices are not reflecting reality. They are too low. So I would easily say the oil prices should be $5 higher than they are right now, simply because we have so much geopolitical risk that I will talk about. I don't want to say we're sleepwalking into World War III, but we are sleepwalking into something because we've got just a lot of macro pieces that are very, very messy. And so when I was sitting in this keynote today and talking, and I'm walking through let's just talk about what's happened in the past few weeks. It is a slug of information that should normally have impacted the oil market, would have probably 5 years ago impacted the oil market differently than it is right now. And so some of those big factors are basically what's happened in China. So, and this war in Ukraine. So right now, China is, again, we'll get into their economy in a moment, but China hosted, so Xi Jinping had this Shanghai Cooperation Organization meeting called the SEO. This was a couple weekends ago, and they hosted India's Narendra Modi, who we have 50% tariffs on India right now, because we upped that another 25 from their 25% because they're buying Russian crude oil. So India and China are the biggest purchasers of Russian crude oil at over 2 million barrels per day. So it's a lot of oil. We slapped this secondary sanctions on them. So, and we've been going through lots of trade talks with India. It's not going anywhere fast. And so Narendra Modi goes to China, cozying up with them, but Putin's also there a couple weekends ago, and so they're all hanging out, and then Kim Jong-un shows up in his train, the leader of North Korea. So all these kinds of fun people who are, doing bad things together are just all hanging out. And India's in this mix, which is very interesting because, it didn't look really good. Hey, are you doubling down with these guys? Because if you're doubling down with these guys, I don't think you're on the right side of history. This doesn't look great. But they all have a lot of cards to play because they're saying, well, screw you, we're just going to do it anyway. And then after that meeting, and this is just within the last 2 weeks, after that meeting, then they host they have Shanghai Cooperation Organization meeting. They've just recently hosted the BRICS Summit with similar nations, but they had a military parade. And so Putin and Kim Jong-un stayed for the military parade. So Xi Jinping is hanging out with these leaders and he's showing off all his military equipment. He's having the military parade. That same day, Trump hosted the Polish Prime Minister. And again, I will bring all these dots together. If you've ever listened to Trump, he kind of does this stuff where he goes all over the place and then brings it together. Or doesn't bring it together. I bring it back together. So Trump is hosting the Polish Prime Minister. I was in D.C. that day, and my first meeting, the people I was meeting with were like, hey, come up to the rooftop. There's going to be some flyovers. And so I went to the rooftop, and we saw these 2 fighter jet flyovers, which were awesome. And everybody said he was doing this for the Polish Prime Minister. And he was partly, but it was also because Xi Jinping was hosting his military parade, and he was like, hey, we have these too. So this is all sort of happening. And so this stuff is happening on a scale like a pretty ratcheted up scale, right? We just dropped the B-2 bombers, that we did in Iran in June, right? And this was we haven't done anything like this in a long time. Like, hey, we can still do this, like drop in, out, and done. So this stuff is just kind of happening. So this is your backdrop. And then Russia just recently, again, I'm trying to emphasize this point that Russia and China are pretty tight. And so Russia just recently just entered their drones went into Poland, 19 of them. So it wasn't just a couple that went sideways, it was intentional. And so at 19 of them, some of them went pretty far into like Polish airspace and into the country. So that means that Russia was actually trying to test what NATO's response would be, because Poland is a NATO country. So that's interesting, and that's also after the Polish Prime Minister was here and everything. So that's just Putin making some interesting moves. So 19 drones into Polish airspace, and then we just had some drones go into Romanian airspace as well. So there's clearly an escalation, and I'm going to show you some charts and data of this escalation and ramp of just the missile attacks and the drone attacks that Russia is pounding on Ukraine have been pretty significant. And then just add into the fact that just a couple days ago, Ukraine hit Russia's one of their refineries. It was 400,000 barrels per day. That's why you actually had the price spike from 61, on Monday to 65 yesterday. So these $3-4 swings in prices are sometimes driven by nothing and sometimes driven by something. But really, your baseline we should be at probably $70 oil, just given all that. So that's kind of your cliff notes and your backdrop. So that's the geopolitics. There's a lot going on there. The nat gas, I do want to talk about that just because natural gas, there's a lot of hype, there's a lot of excitement. EIA, which I'll show you here, EIA has a outlook that they just put out this month, and it shows a spike in natural gas prices for next year. And I think there's a lot of folks banking on this, right? That we're going to have a spike in natural gas prices, that AI is crazy, and we got hyperscalers, and everybody needs data centers. I'm not saying this isn't the case, but it's interesting that they show this because they also show a decline in oil prices. So there's a lot of interesting moves going on there. And I think and then power generation just broadly, have to spend some time on that. We talked about this at dinner. Not everyone agrees with me, and that is perfectly okay. But we have some problems in this country with power generation. We have more energy than any nation on Earth. We actually have more coal reserves than China. We have more natural gas and more oil production than any nation on Earth. Russia is the second largest producer of natural gas, and we produce double what they produce. Double. So we can solve our own energy problems and the world's over easily with natural gas. But we still have rising electricity prices. So we're going to talk about power generation because I think there's a lot of excitement and a lot of hype on nat gas based upon the thinking that AI is going to demand so much of it. And not that they're not, but I think we have to be careful of how many BCF a day, how many BCFs they're actually going to demand and how that converts into the power side. And AI is going to evolve a whole lot. And also we are thinking about AI in a lot of different ways, making people more productive. Cat videos and Tom Cruise videos, and everybody talks about these videos. China's not thinking about it from that perspective. They're definitely not thinking about cat videos. It is about military. And so it's a really serious divergence into how we are thinking about this AI race. And today, NVIDIA, the big chip player you guys probably have all heard about, China just came out and said they are not buying any NVIDIA chips. So that's done and dusted now, and that's a whole big thing for NVIDIA. I'm assuming their stock has dropped on that news, but I didn't get a look because I was at this conference today. So just a little bit going on in the world, no big deal. And then OPEC Plus, we'll walk into that too. There's a lot of reasons why Saudis, and it's largely Saudi. I mean, there's other countries too in OPEC and OPEC Plus, but when we talk about OPEC, we're really talking about Saudi Arabia, and they have increased output, or they're slated to increase even more. They basically, this is really about Saudi Arabia taking back market share. They cut 1 million barrels a day a couple of years ago, and that gave the market like a sense of cohesion. It made everybody feel like OPEC had a plan. It was just the Saudis, like, no one's going to help us, so we'll just do this. So they gifted the market this 1 million barrel day cut. And quite frankly, if the Saudis had come to me and paid me and said, what should I do right now? I would have absolutely told them, put your barrels back on the market. This is not a horrible time to do that. You've got it's not like you have a lot of blood in the water, but it's not a super great market, it's not a super bad market, and you get to take back market share. And by the way, the geopolitical risk looks so high. Iran's going to have to get sanctioned at some point. Russia's going to have to get sanctioned at some point. Some barrels are going to come off, and you're going to be in that place to have these barrels back. So at the very least, they just want that market share. They want those barrels back. So if the market share presents itself, they can take it. So to me, it's a lot more sensible. And when this happened, we haven't heard a lot of smart talking heads on TV explaining this very well, of like, hey, this actually makes sense. Don't freak out. But that's basically what it is. And what I've told clients and podcast listeners and stuff is, it does make sense, and we shouldn't really freak out. It's not a great time because it came after like Liberation Day, Tariff Day, and then everybody lost their minds. But to be frank, the oil industry was already getting anxious in March. And then, so we'll talk about the U.S. economy a little bit and U.S. shale activity. So a lot of ground to cover. I gave you a lot of the answers up front. So WTI futures are not amazing because they just tell you, futures prices just tell you what the bet is on oil prices today, right? If oil prices change tomorrow, the futures curve is going to change with it. But that being said, this is roughly, we're 64 and the curve is up here. This bet on natural gas is interesting because I'm hearing so many people talk about this, and I did have a lot of questions today. Should we hedge nat gas at 4? And quite honestly, it's a great question. I think you should think about layering hedges as you go into the high 3s, and I'm not advising people on what stocks to buy or anything, but absolutely on hedging on nat gas. Gosh, if you're exposed and you can start layering hedges in the high 3s, you might. Yes, we have a lot of optimism on demand. We have a lot of optimism on LNG exports, but we are very, very good at producing natural gas, like exceptionally good at producing natural gas. And we've only had one period, where we had this height in natural gas prices, and that was in 2022 when we had this Russia invaded Ukraine. Natural gas prices averaged $6.50 an MCF. In 2024, they averaged $2. So, boy, I bet people wish they would have hedged to that $6.50 level because $2 does not feel great. And right now, it feels like $3 must feel amazing next to $2 because people are off to the races right now with nat gas. But we are so good at producing it, I think we could easily see ourselves in a scenario where we're producing a lot more. And we are producing a lot more. We're producing 130 billion cubic feet per day of natural gas, which is a crap ton. So historical crude oil prices this is, a look at like money of the day versus 2024 dollars. The point I'm putting here, this came from the Energy Institute, which is the former BP data. And the reason I'm putting this here, just to give you perspective, is that, we had these price spikes before. This is where we're at. We're not at that bad of a place. And the reason I say this is because the sentiment I have seen across the industry this year has been really bad. I mean, a lot of cranky people in the oil and gas space are just like, well, the world is ending. It is not ending at $64 oil, okay? Like, it is absolutely not. Now, it truthfully, that this chart matters because we've had a lot of inflation across the board, across the economy, and particularly in oil and gas. $65 oil is not the same as $65 oil was 5 years ago because we've had inflation. But that being said, that's kind of, that's reality. It's not 40, but people were sort of acting a little bit like, oh my gosh, it's going to 50. Yes, the Trump administration sometimes uses that 5 handle. I don't think that's productive, and we should stop using that. But we aren't, that all being said, we're not at $50 oil. So we do see some inventories, and there's some interesting stuff going on here that this is what IEA is forecasting, EIA, Energy Information Administration, our U.S. entity. EIA is here and forecasting inventories to go up, which correlates to what they're saying that oil prices are going to go down. I have not heard a lot of news entities like picking this up, but I found that a little questionable, and basically saying we're going to be oversupplied. This is what they had last month, where they basically are showing inventories are up, prices are down. So there's some interesting stuff going on there. I don't want to, lots of folks like to look at crude oil inventories and say that's the reason why we should be bullish or that's the reason why we should be bearish. We do have to be careful with crude oil inventories, and I say this because it's a metric you probably have heard a lot or hear people talk about. It's sort of like rigs, it's sort of like frac fleets. Just take it with a grain of salt because we produce so much now in the U.S. that inventories matter less, right? We don't need as many inventories because we have so much production. So think about what inventories meant 10 years ago. A lot different what they mean today because we weren't producing 13.6 million barrels per day 10 years ago. So everywhere, and Saudi is going to be producing 10 million barrels a day again. Russia is producing 10 million barrels a day. We have plenty of supply. We're not short supply right now. So that being said, I wouldn't say I'm going to take a bet now. We're plateauing on the rig count. And that's really interesting because I was talking to my clients weeks ago and saying prices are not low enough to dictate this drop in rigs. So we have to see a flattening at some point because we're losing our minds and we're dropping rigs like crazy and it didn't make sense. Frac fleets have come off, but you notice the frac fleets have popped a smidgen, and who knows if we'll stay there. We probably could use a little more, we could lose some more frac fleets, and that is because the horsepower of this 169 frac fleets is nearly double what it was just 5 years ago. So we have way more horsepower, and so when we think about a frac fleet, that's probably not a good measure because a single frac fleet now does a lot more work than a single frac fleet did several years ago. And you often have multiple wells being fracked at once now. Like simul-fracking is a regular thing. Trimul-fracking is a regular thing now. I mastered that word. That's 3 wells at once, trimul-fracking. It's pretty nerdy and cool. So that's happening. And so there's a lot of efficiency and a lot of productivity gains that's happening from this, right? That we're doing this at once. And so the fact that that's kind of might be plateauing, and then no one had their bingo card that we would drop rigs like crazy on oil, and then 20 of those rigs would go to nat gas. I didn't think anyone thought that we'll just flip those puppies over at $3 an MCF, but that's exactly what happened. 20 of them went over to nat gas, and you are seeing companies, especially frac companies, even telling you that the service companies saying, hey, we are disproportionately exposed on nat gas, and that tells you that nat gas is good, the momentum is good, and so there's lots of things going on there. But all this being said, we don't need as many rigs because we are producing plenty with less rigs, and I'll show you that in a minute. All roads lead back to China, and I have to put a China thread in here because so Mexico is doing 15% tariff, or talking about doing a 50% tariff on China. Now everyone and their dog got on TV and said, and NPR and Lord only, you name the news channel, everybody has said, I can't believe we're tariffing our allies. What are we doing? This is horrible. It was all about China. All of this was about China. Because Canada and Mexico are so heavily exposed to China. And so now that Mexico is talking about tariffing China, that makes sense because their investments are so heavy. So the reason we're tariffing Mexico is not because it's just Mexico, it's because all the stuff coming from China is so big. So basically we pressured them and they're coming to the table. Now this hasn't worked with India, right? We put the pressure on India, and India has not come back and said, hey, we relinquish, hands up. They haven't done that yet. They probably will have to at some point because the pain is pretty hard. But right now they're saying, okay, we'll play ball. We're going to play this game. We're seeing shipments from growing LNG Arctic shipments from Russia going to China. It's not like China's not taking a ton of LNG natural gas via pipeline. They are increasing their natural gas imports via pipeline, looking like they're going to do the Power of Siberia 2 project, which Putin and Xi just agreed to about 2 weeks ago, which Putin's been wanting to do for a long time. But China gets a lot of crude oil, a lot of natural gas. They probably get more crude oil than we think, actually. They probably get it via truck, via rail, via barge. They're buying a crap ton, and they're stockpiling it. They're stockpiling grain, they're stockpiling oil, they're stockpiling coal, everything. So China is directly funding this war with Russia. They're giving them all the money. They're also giving them military equipment and autos and chips and all kinds of things that the rest of the world has cut them off from. I just put that of all roads lead to China because they really do. There's a big China thread. But just so you can see it in thinking about tariffs, because I get asked about tariffs a lot in terms of what's going on and the impact of the economy. And I can say that, is it the best tool? Maybe not. But this is the first administration that has been willing to change the rules of trade with China. First administration in 40 years. Basically, when we let China into the World Trade Organization, they decimated our manufacturing. People say it took 20 years. No, it didn't. It took 2 years, where you just hollowed out sectors of our economy because it was so cheap to produce this stuff in China. And then these companies, all of our companies went to China and started producing this cheap stuff. Well, everybody says that's so good. It's globalization. It's awesome, and you get this cheap stuff in Walmart, and we can all buy it, and it's awesome. Okay, and that's the same argument they make, by the way, for buying cheap EVs and cheap batteries and cheap solar panels and cheap wind turbines from China, is that it's deflationary and it's a good thing. I don't know if you would need all that cheap crap from China if you had a decent job. You know, maybe you wouldn't need that cheap piece of plastic that you don't actually need. If you had a decent job, you wouldn't have to buy it. So, you know, this is what happens with inflation and jobs and everything. And so now everybody's realizing, hey, this is a problem because China's actually not our friend. So we should have been more careful about going into bed with a country that we don't align with on many levels, but now is a strategic competitive adversary, has been and will be. And so our trade, our imports look like this. This is millions of dollars, that's 50,000, so you have a ton. They've come down a smidge, but that's our imports from China, okay? This is a fraction of the figure, and that's our exports to China. We've never got the market share that everybody's touted. Clinton, Bush, it doesn't matter. Republican, Democrat, everybody kowtows to China, every single one. Is that, no, we want the market share, and they get enough businesses to come into the White House and say, no, we need to keep doing business in China. And they get their way every time. They get their way. The only people that get screwed is the American consumer is getting screwed and the American jobs. But really, the exposure is, everybody says these tariffs are about jobs and manufacturing. They are not about jobs and manufacturing. They are about stemming the pain, like just first and foremost stopping the bleeding of losing any more jobs, but also it's the manufacturing industrial base. If you do not have one, you quickly become a very vulnerable country where you are exposed to things like what Russia has done to Ukraine. You have got to be able to defend yourself, and you do prevent wars by, you know, if somebody thinks you're going to hit them back if they attack you, you do prevent that of like they don't want to attack you. You have to have a defense industrial base, and that manufacturing base is very, very critical to that. And so the ability to just manufacture anything helps you with the knowledge and know-how, and it helps you be able to build lots of things. And so in World War II, we built the Big Inch pipeline in 12 months. We built a massive pipeline in 12 months because it was World War II and we had to hurry up and build it. And you know, everybody talks about wars being fought on oil, and they absolutely are. Like oil in World War II was a really big deal. You know, we saved Britain's ass with our oil, and we got it over there. We helped them. Our octane was amazing. You know, we had really high octane and helped the planes. We always think about that though, and that's critical. But it's also the planes, right? And it isn't oil, and maybe actually then it was kind of oil powering. Now it's natural gas. You have to have power generation to make the planes to fight in the war, or to not, or just have the plane that's made here that we actually fly in the air every day. You know, you have to have manufacturing, and you don't have manufacturing if you don't have power generation. And so we have all this energy, and we have to harness it and use it. And so this is a like head-to-head competition in terms of just economically speaking, national security speaking, economic security, but also if you're thinking about the future of where we're going in terms of competition, it is not just about making Barbie dolls, which we can't actually make here because we have all this ethane, but it's about being able to make ammunition. So that's Chinese exports. There was this big spike. All their data is fictionable, so lots of grains, buckets of sand that you have to put with this. But they did have a spike in their exports because they were front-loading with all these tariffs. Okay, so now we're going to get back to production a little bit. This is U.S. oil production and oil prices. So pretty steady grind forward. I put this here. You guys are probably familiar with this. It's good to kind of just stare at this for a minute because you see a trajectory down for oil prices, but you see this grinding here, this like grinding forward. People said we wouldn't do this, right? People said like when we drop the rig count or we have longer laterals that something's going to drop, right? The decline curve won't hold up, the productivity won't hold up, and none of that's come to fruition. And so I do feel like while I don't hear the industry like shouting from the rooftops like, wow, 13.6 million barrels a day, I hear them saying, how did we do this? Like, because, they're asking themselves, like, how did we get to 13.6 million barrels a day? We're kind of pulling back. And so it is the stuff under the hood. And so it's why it's really important to look at it. And if we as an industry are talking about that, and if I'm saying this, I guarantee you the Saudis do not understand it. Like, I can promise you, they do not understand what is happening because they are not that close to it, and they literally cannot think unconventionally, like outside the box. They can't do it. So this is natural gas. This is why I'm concerned about production, because we're very good at producing this. I mean, think about the Haynesville. Okay, somebody's talking about today, and these are monster wells. These are 20,000, 30,000, 40,000 MCF a day wells. Huge wells. It's deep, it's thermally mature, it's high pressured, it's hard to do it, but like, man, once you do it, this stuff comes out, and it comes out fast, and we can produce more natural gas. And so that's my concern, is that as we're doing this, if we do get some price spikes floating up, this is important too, is this is your NGL composite price, and that is holding up. And so that has really kind of held up if you've got some liquids. This is why I think we're starting to see, like EOG is going to town in Ohio, in the Utica. You're starting to see momentum there. You're seeing it in the Eagle Ford. You're seeing all the stuff of, this NGL play, this condensate wasn't so sexy, and now it's getting all hot again. So there's just stuff going on nat gas that I think is great. It's really, really good, but be careful what we wish for, because we will produce it. This is oil production. This is your money take-home chart of, like, I've said a lot of things. If you can't remember anything, or I'm talking too fast, this is the one you want to remember. This is production in kind of gray. That's your rig count in purple. And this is your average lateral length in orange. Very simple. This is what's happened, is our rig count has dropped, during COVID, never came back to where it was because we didn't need it to, because these rigs are running, you kept your best rigs, you're running flat out, they're super efficient, but we're drilling longer laterals. So this is your average lateral length in the lower 48. So it doesn't seem like a lot, but incrementally you are moving that up. And so this is, some wells are 3 miles long, some wells are 4 miles long, some wells are 5 miles long now. And that's really impressive, because several years ago people did not think we could even do that. They thought we could drill it, but they just didn't think we would be able to complete efficiently that 5 miles out. And that is amazing. I mean, really, to think 2 miles down from here and 5 miles out, we are drilling, completing wells. That's incredible. Like, absolutely incredible. And so we are in the early innings, I think, of really maximizing, I think, that recovery, especially at the toe of those. But that being said, this is what's happened. You've taken the rig count down, you've kept lateral lengths up, and you're kind of grinding forward on production. And interestingly enough, that's what we've seen. We have not ceded market share to OPEC. And I think a lot of people thought that's what would happen. They just thought, hey, we're going to drop oil prices, $60 isn't great, 60-ish isn't great, and we need to have higher oil prices, so we'll just drop production in the US and prices will come back. At least that's what Diamondback told the street. And that's kind of not the most accurate way of thinking about the market, right? Is that, you can't just put out a letter and assume everyone's going to do it, and also assume that's probably not the best thing to do. Why should the U.S. drop market share? Why should we drop oil production? Because we're not guaranteed that the rest of the world will. And actually, countries like Kazakhstan have said they're not going to, that they will actually increase output until oil prices come back, because that's what OPEC countries, some of them, like to do. This is our strategic petroleum reserve, something you guys have probably heard about. We are filling it back up. Chris Wright, our now Secretary of Energy, has talked about this vocally. When you push it together and squish it like this, you can see that this is oil prices, that's the SPR. It is being refilled. Not being refilled as dramatically as we could, though, and that would support prices. And these are decent price levels that the administration should be refilling the SPR, and they are, but they need to be, it is supportive in that there's a floor on oil prices, because if they get too cheap, we should just be filling up the SPR like crazy. So that's what it looks like if you sort of zoom in. The Biden administration did drop oil prices. They did sell off the Strategic Petroleum Reserve and put oil on the market because they desperately wanted lower oil prices. It was not because the world didn't have enough oil. We had enough oil. It just wasn't moving around super fluidly because we had Russia invading Ukraine, and Russia finally got their shadow tankers all together, and now the crude moved. So there was a short time a few weeks where the crude wasn't moving perfectly, and then it moved around. And so that price spike was fear-driven. It was not necessarily supply-driven. Great time to hedge would have been then. LNG exports and prices. So right now this is our LNG exports, and you can see we're hanging in this like 15 billion cubic feet per day, about 15 BCF a day is what we're exporting. That's prices. It's not horrible. We haven't really, we have more nameplate capacity. We could be exporting more technically. We have a lot of capacity coming online. That's our pipeline exports and prices. I heard a lot today about horrible Waha prices. You want to get some negative talking about nat gas, talk to some Permian producers, because it is not a fun game to be producing natural gas in the Permian, because you do often get negative pricing. And so we do have to have more takeaway. Like, another big, literally underlying takeaway is that we need more infrastructure. We have to have more natural gas pipelines. We have to have the compression. We have to build out. So, and you guys are amazing in the state because you build stuff and you build pipelines, and people want to put the drill bit in the ground here because they know that the pipelines are going to get built. There's very few places in the country where people feel comfortable with that. So really, really important that we have to keep building that. The problem I have here with this is that we have the nameplate capacity, we're going to increase it, and we should be increasing it. Biden put a pause on this in January of 2024, and it really spooked the global market because they didn't think they were going to be able to get future LNG supplies from us, because that's just not a good sign. And then, obviously, Chris Wright's been approving LNG exports like crazy, and that's not a bad thing. It's okay to have redundancy. Like, I can't emphasize that enough of, like, pipeline redundancy in gas and oil. That is okay. That is what you need as an operator to have prolific basins to produce. When you have short pipeline capacity, that's when your differentials blow out, and that's when you have pricing problems. But we need the ships. So again, back to the military thing, we need ships for the military. We also need them for LNG exports, because you have to put this gas, you have to liquefy it, then you have to put it into a ship. That's why I like coal. And I'm being very honest, I love coal. I think coal is awesome. And there's lots of reasons why I think coal is awesome with natural gas. Super important, and it makes natural gas even more awesome. This is your global LNG exports. So of the global market, we have about 100 million barrels a day oil demand. It's a 100 million barrel a day market, roughly. And I'll show you this in a second. The gas market is 400 billion cubic feet per day. And this is LNG. So of that 400 BCF a day, 53 BCF a day is on water. The rest of it is all captured by regional pipelines, right? This did not grow year over year. So that's 2023, but 2024, it's the same number. And that's telling me that we haven't developed the markets. It's not like we can't grow it. It's not like Asia doesn't need it and these countries need it, but we need more ships. And it seems to be there. I think that's where the bottleneck is. Natural gas pricing, poor Ryan has to hear this again. I was railing on this last night at dinner, was talking about it in my talk today. This is a really, really big deal to me. I am not happy with utility companies. I am not happy with regulators. I am not happy with power purchase agreements. I am not happy that the consumer gets screwed by the utility provider. And I can show you how they're getting screwed, because this is natural gas prices. Henry Hub. Last year we were at $2 an MCF. Absolutely brutal for the industry. Here's where we are annualized in green. The red is your residential natural gas prices. Notice that it has been widening. This is not okay. Okay, it really is not okay. And so when the Trump administration talks about why we should have lower oil prices, and that's great for the consumer, and it really helps because they can quickly lower inflation. And that's why when we have drill baby drill and let's produce more and let's have low oil prices, it isn't because he hates the industry. It's simply because we've had so much inflation. It's so easy to, if you lower oil prices, people feel better. And it's actually deflationary. It's the one thing that you can actually lower prices on. Nothing else. When prices go up, they never come back down. In the oil world, they do. This would be awesome. If we could start passing the savings of natural gas prices on to the consumer, that would be amazing. Also, really, really important is that the consumer's not getting the benefit of this. And as an industry, that's not really good, because it means we need to be telling the consumers they should be getting this benefit, because what's going to happen when we get a natural gas price, say we go to $4 an MCF? It's going to be good as an industry, but the consumer, who do you think they're going to rail at? You think they're going to rail at Excel Energy or the utility companies? No, they're probably going to rail at the natural gas industry for saying, just like when Biden wrote the letters to the oil industry and said, hey, lower those prices at the pump. That's not how it works. But this is a problem where natural gas needs to get involved in understanding electricity, because the demand for electricity is huge. We need more natural gas in the pool, but we need the price savings to get passed along to the consumers. And I'll tell you why they're not in a second. This is the EIA. They're projecting so this is their projection of WTI declining. This is a little messy because we're in BTUs, right? But they're showing this price spike in nat gas for next year, and they're basically banking on this massive LNG export bump. Again, I don't know why a lot of people aren't talking about this. It seems really big. We are seeing some momentum shifts on this kind of net zero movement. There is a pullback from that. A lot of it's because it wasn't realistic. You still have a lot of pay being tied to ESG metrics, so a lot of CEO pay still being tied to ESG metrics. That's problematic. But when Shell is pulling out of these emission standards and other companies are following suit, it's because they can't hit them. They're completely fiction. And so they've just basically said, we're done. Now, Trump did help with this a lot because he pulled out of the Paris Climate Accords, and I've long said that movement that we had, that craziness during 2020, that net zero Bananaville of, that was Bananaville, that was nuts. And the IEA, just a reminder for folks, IEA, the net zero, the whole thing, is a 25 million barrel a day demand drop between 2025, by 2030. So in 5 years, we will lose 25 million barrels a day demand. That's what net zero is. So if you guys are all for it, we should have a talk after. Because there's just a lot of economic consequences for that. So electricity prices and our grid. This is what's actually happening here. This is electricity prices. This is a real big problem. This is just makes me, I'm just livid about this. We had flat, no inflation on electricity prices for a decade, for like 2 decades. And then COVID rolls around, but it wasn't COVID that did this. This was the net zero, the ESG craziness, the green policies, and everybody shoving the wind and solar into their grid. But really, it was at the expense of the baseload power, the coal. So China adds wind and solar into their grid, and they keep the coal. And it's not about cost for them, it's about energy security. So if they consume a little bit more wind and solar, and it saves a little bit on coal, even if it's inefficient, it's just energy security because they can stockpile more coal. For us, we're the only country that likes to take the baseload, cheap stuff, take it down, and add this wind and solar, and now we're adding this nat gas. Super important, because nat gas works really well when I have the coal. See here where we have this nat gas and coal, and I want this flat. Now when I start decommissioning this coal and have this nat gas, what do you think is going to happen to electricity prices when nat gas prices spike to 4 something, and half of our grid is nat gas? It's not going to be fun. And what do you think utility companies are going to say? They're going to be like, oh, whoa, we got to raise the price even more, even though Xcel is raising my rates on nat gas every quarter they raise it. And they say it's because they're building out infrastructure, which is just not true because the pipeline's in the ground. It's already built. So we don't have that problem, but that's what's happening. And so really what it's being is these utility companies are paying a lot of money for the transmission for renewables because you have to build out a lot of transmission. And they're really expensive. So when you add wind and solar into a grid, the prices go up. Full stop, period. That is what happens because they're intermittent sources of power that are not easily dispatchable. And so now we actually have more wind and solar. So this green is wind and solar. This is from EIA. I'm not making this stuff up. And that's your coal-fired power generation. And the reason that's so important is I do like coal because it is extremely energy secure. And it works really well with nat gas. And we're using a drop in the whole global bucket. We're using hardly any. But it's also really important because it's a baseload cheap dispatchable power. And so we're decommissioning the baseload cheap dispatchable power and we're adding a bunch of intermittent not dispatchable power. And that's a recipe for price spikes, and we've just started, and we're already really high. And for me, it's very sad, it's wrong, and we have more energy than anyone on Earth, so this shouldn't be happening. The power generation that EIA is showing is that we're gonna, for next year, we're gonna add some more natural gas, but we're gonna add a bunch of wind and solar too, so awesome. I can tell you where electricity prices are gonna go, one direction, up. That's your demand outlook, just looking at OPEC, EIA, and IEA, and you can see the gap is OPEC is a little more bullish than everyone else. That's usually where they're at. And the only reason I'm showing you this is that everybody's calling for some softness in 2026 for oil demand because we're going to have too much supply. It's squishy. This stuff changes a lot, but the point is that outlooks are all over the place. Actual demand, where we've been, demand is always backward looking. Like we won't know 2025's demand until next year, right, when we can clearly see it. And this is what it looks like. This is global oil and natural gas demand. Your axis for oil is here, it's in black. So you can see that we were just over 100 million barrels a day demand in 2024. This goes to 2024, it says 2023, but that's through 2024. And that we're about 400 billion cubic feet per day for nat gas. And just notice it's a really clean line for nat gas. So you can bank on, we do have a clean trajectory of correlation of upward demand growth for natural gas. It's not 30 BCF a day growth every year, but it's nice, clean, incremental growth. And we have ability to grow that a lot because there's so many countries around the world that have not pulled this natural gas into their power generation. And they can displace coal to a large degree. And they could actually use it with coal, which would be would help them avoid the price spikes and be energy secure. Now, the reason I kind of rag on and rail on this coal stuff a lot is because the reason we are decommissioning it is supposedly because of CO2 emissions. Now, here's actual coal consumption globally. It's at 165 exajoules, so that's total. So it's at all-time highs. So for all the stuff that everyone is doing in the world, which is basically just the U.S. and Europe, we haven't done much to the coal demand. In fact, it's gone up. This is China. So China is more than half of global coal consumption. And notice where they look. They are just on one road up. And that is again, another takeaway. That's their whole economy. They're banking everything on coal. That is really meaningful because coal is, like I said, is a rock. I can stack it up. It's super energy secure. China has complete energy security in coal. They're using more coal now than they did in 2015. I mean, that should tell you a lot about the country and the economy and everything, is that there's one trajectory for that. That's what they're building their manufacturing powerhouse on, is coal. That's because they have it. They don't have oil. The other really important takeaway on electricity is this is total world electricity. So 31,256 terawatt hours. So this is what it looks like. That's total world. China is 1/3 of that. That keeps me up at night. This makes me very, very concerned that they're like this and they have 1/3 of the world's power generation, and we're this blue line here where we just upticked. So if you're gonna, do anything in competition, whether it's business or whether it's military, you need the power to build it, and they have the power to build it. So when we talk about AI and we talk about robotics and we talk about needing energy, and that's what everyone's talking about here in the US right now is AI and hyperscaling and doing all this stuff. China has it. It's an afterthought now because they built out this power generation and they're subsidizing it like crazy. So if you're a biotech company or robotics company, you will get free rent in China, you will get free utilities, you get free everything. Subsidized to the hilt because they want it. And so they just throw everything in the kitchen sink at it. And that's just for comparison, that's Europe that's declining. I don't know how Europe can say that they're going green when they're not building out power generation. You cannot electrify your economy if you don't build electricity. So they're not doing it. They're just declining economically. That's Chinese oil and natural gas consumption. Everybody talks about this. Most people don't have the data. But natural gas consumption, it's about just over 40 BCF a day. The oil consumption is more important, is this black line. China's economy has not been great they had zero COVID. They shut their economy in. Literally, like, Shanghai was shut in for 2 months. Massive, massive city of 20-something million people. There's no way you can grow oil demand when you shut in your major cities. Like, it just doesn't make sense because no one's driving. So that's not real. The figure on paper, they're taking it in, but they're not necessarily using it. And so it's one of these many mechanisms that's clouding this oil market that we have, where we have trouble with supply and demand. Part of it is China. China's stockpiling at least 1 to 2 million barrels a day of crude oil. So that's kind of holding up. That's holding up prices to a degree, but it's not a real demand story. Their unbalanced economy, they have a very, I say it very simplistically, is that think of the property sector, think of you buying a home, you are the consumer. Think of a big manufacturing center, like for China, they're all government owned. So the manufacturing sector is on the rise and the property sector is on the decline. So the consumer's on the decline and the government and the manufacturing is on the up. And they're really they're not like doubling down, they're tripling down on this game plan. So it's a very messy economy. Okay, switching back to the US. This is our demand, and so apparently today diesel demand was off by a smidge. This is monthly, so this will be updated next month, but this is your latest and greatest, and it's pretty clean. That's your oil demand in black, and it's product supplied, so it's diesel, it's crude oil, it includes propane and NGLs as well, but roughly 20 million barrels a day. But you'll notice that when COVID happened, we came down and we never quite came back. Sorry, that's gasoline. That's not total. This is your gasoline. We never quite came back on the gasoline. And really part of that was because we had this price spike and then we had all this other components of inflation and it just never quite came back. But we're still driving a lot. And then jet fuel is the big one, where jet fuel, ethane's in blue, where you can see we've actually jumped a little bit in ethane, which is awesome. And jet fuel is okay, like that's in purple. Lower oil prices do help that, right? So 60-ish something dollar oil does give your economy a little boost, right? It gives you a little jolt to your economy because it keeps things holding up. Like, people are going to fly if they've got $60 oil because it's not that expensive. If your economy is weakening and then you have $85 oil, you will drop airlines because prices are going to get too expensive. So there's some things that are going on that just matter. That's jet fuel demand and this other oils category, and you can just see there's a pretty nice correlation between oil prices and jet fuel demand in terms of maintaining that demand. This other oils category that jumped, that's got some jet fuel in there, and some other stuff. And so it tells us that we're flying a lot. So this war in Ukraine, and I know I'm running out of time, but I'm going to try to be fast. Are we good?
Yeah.
Keep going? Okay.
Maybe 5 more minutes.
Okay, we're going to rush through this. So war in Ukraine, this is where we started, day one. So that's February in 2022. This is what the map looked like of this war in Ukraine. Russia comes in. No one believes they're going to do this. They did it. Now, fast forward, this is North Korea entered about a year ago. Last year is when North Korea came into the war and started helping Russia. And then here's where we're at now, what the map looks like. So we're 3+ years in this war. Doesn't look like it's ending. Well, we're going to skip over that. That's Europe's exposure to nat gas. Russian crude discount. Okay, so here's your Russian drone and missile strikes. Really pretty significant ramp up in the past couple months. And this is collectively, what's happening is that Russia's just bombarding the air systems of Ukraine when a lot of these are fake, right? Not all of them have an actual attack mechanism on them, but a bunch of drones, a bunch of missiles, you overwhelm the air defense, and then you can penetrate the air defense and you start striking stuff. And that's what's been happening. And then this is your 19 drones that went into Poland, and that is basically Putin just saying, hey, NATO, what are you going to do? And trying to test out what NATO's response actually is. I told you about this meeting. That's Kim Jong-un and Xi Jinping. So we told this is, we talked about China. That's a little bit more. So just to put a finer point on China's economy, that's their cement production. So that's, again, that property sector that's declining. Hard to square how you would have rising oil consumption if you have things like cement production declining and steel production declining. Okay, so OPEC, and then I'll close with U.S. shale. This is all these OPEC meetings. When they come out and OPEC has a meeting and they say they're increasing output, this usually happens on a Sunday, and you see oil prices come down Sunday night, and you see it on Monday. Most of the increases, basically Saudis say, we're increasing 300,000 barrels a day. Saudis take most of that, right, on paper. So the Saudi number, the last one they put, it was 137,000 barrel a day output increase. It just put Saudi, notched them above 10 million barrels per day, and that's what they wanted. So this is just about Saudi taking back market share. Yes, some of these are fictional, but no, this theory that the industry has that OPEC cannot produce, I just don't buy this. It is I don't know where it started. I hear it a lot, and it is everywhere. It is prolific within the oil and gas sector, and it helps the oil and gas sector believe that we're bulls on oil prices because OPEC can't produce it. Well, let's just find out, okay? Because in 2020, Russia produced 12 million barrels a day, and Saudi produced 12 million barrels a day, and we tanked oil prices. So that wasn't fun. So I don't want to test that theory, but I don't believe that's true. OPEC does have the spare capacity. Whether or not they produce it and how they produce it, those are finer points in the timing, but can they? Absolutely. They are capable of producing a lot more oil. We are too. So if you look at Saudi production, you can just see it. They keep notching this up. We don't have to get into this. It's a little too technical and nerdy, sorry. Russia and Saudi and US. So another just take-home slide for you. That's US production in black. That's Saudi production in red and Russian production in yellow. That gap out is pretty amazing. This is a really incredible story of our dominance. And so when people talk about energy dominance, it's so serious. And we need to be talking about how we maintain this output because we're producing more. We're exporting about 11 million barrels a day of crude and product. I mean, it's a powerhouse, and it has a huge implications to this economy. Huge implications to the Fort Worth economy and the Texas economy, not just because you produce the oil, but because we're not importing the oil. Right? If we're exporting 4 million barrels a day, that is money in the bank. That is a huge deal. And so we have to be talking about how we maintain this. And this is leverage, right? This is massive leverage on these folks that we don't get along too well with. That's Russian exports. It's just been super maintained. China imports. China and India both take a lot of crude oil from Russia. Okay, U.S. economy. Another finer point real quick. That's U.S. production again. That's our exports of crude, and that's our imports. And so if we drop our output, we will be exporting less and we are going to be importing more. And so that importing more is a really serious story. Something that the Trump administration, I think, could be keen to hear from the industry is, hey, we need $70 oil because we want to help you maintain this. Because if we don't have decent enough oil prices, we'll drop output and then your import bill will go up. And the whole game of this administration is to not increase the import bill. Our economy, we have over $18 trillion in U.S. household debt. That big red chunk here is mortgage debt. There's stuff going on in the hood. I'm not super confident we have a lot of mortgage debt. This was 2008. It's this chunk here where those are pretty high interest rates. Obviously, interest rates are coming down. People are refinancing. Everybody wants to keep the ball rolling, but there's a lot of stuff going on in the hood. That's housing and WTI. It's pretty tightly correlated. We actually have a lot of houses that have been built. We have a lot of apartments that have been built. No one's talking about that. We don't all have to live in a home. I mean, if people want a home, you can live in an apartment. It's okay. We don't all have to own a home, and we have a crap ton of apartments. Our unemployment, this is oil prices, unemployment in purple, inflation in orange, interest rates in black. I don't like that the Fed lowered interest rates today. They shouldn't have lowered interest rates today. We still have too high of inflation. They did lower it by a quarter basis point. I didn't get to see it, but I'm going to go through it. We've been hanging in there with this, unemployment hasn't ratcheted up, so there's a lot of unique factors happening there. Probably another time because I'm over time. And the last thing I just want to show you in this one slide, I'm closing on U.S. shale, is something we talked about today, this Woodley pen thing. This is your chart of your map, of public-private rigs in the U.S. And I put public rigs, all public companies, in orange, and private companies in purple. And I say this, we have all this consolidation in the business, and this is a map today. So we still have a lot of rigs running. But you notice the purple, the private companies, they are not in the core. So when I hear a lot of people talking about we're running out of core and we're going to have peak shale, and well, the privates are not even. There's so many companies that aren't even actually in the core. So I'm not saying that's that we aren't running out of that top stuff. But what happens is when you push this industry, they respond, and so the industry is already responding to that to a large degree. And so I'm just very careful when people say like tier 1 and tier 2 and tier 3 and the core of the core and all this stuff. That doesn't, it kind of reinforces that narrative too, that we're running out and prices are going to go up. And I'm not saying that prices are not, we won't get to that point where prices have to ratchet up to say 75. But it doesn't mean that prices go to 100 and you stay there. It means that you kind of gradually move higher and that happens. But also is that you still have a lot of activity by a lot of companies. So I'm going to stop there and thank you for your time. I know I gave you a lot of information and probably too much, so thank you.
I'm going to do questions?
Yeah.
We'll
How about it,
open up
guys?
for questions.
So the last thing you said, if we'd been in this room 25 years ago, there'd be talk about peak oil.
Oh, yeah.
Are those two words that'll never be spoken again?
Like Hubbard, peak oil, yeah.
I mean, 25 years ago, I said, well, we've just about got all the way done, and then the shale boom.
Yep.
Yeah, so is that kind of thinking gone now?
It should be, but it's not. It's not. We still hear. You still hear it, and so this is why I cut my teeth on U.S. shale. I'm third generation oil and gas on the labor side, and I'm really confident that we have plenty of oil. And because every time there is a little bit of a step change. So, when people are talking about running out of acreage, well then let's talk about what happened to the parent-child problem. That used to be a really hot topic to say, well, we're running. Oh, but the parent-child problem, that's not going to work. And then, okay, it's working, right? Yes, it's some wells don't produce as much, but everybody's making it work. And now the industry is pretty economic, and it's kind of all working. So I'm not saying that's not happening, but we haven't got to the point where we've stopped drilling new wells. So when we get to the point where we're in this room and we say, okay, all the wells are drilled up, there's no sticks left on the map, we can't do any more, then everyone will start going to refracs and thinking, okay, what can we do? And we're not even close to that. So I just, 25 years ago, people thought we tapped out, and also Chevron almost sold off the Permian not that long ago because they didn't even know what they had. So when I hear a lot of private companies, like what Ryan's doing, what private companies are doing, the small ones, gosh, they incrementally move the needle. Because when you hear private companies that are like, okay, well, I'm here, I'm kind of in this area that people don't like, but we like it, and it's like, okay, well, they'll keep doing that for a little while. Give them the funding, and all of a sudden, it's going to look okay, And that's how you de-risk stuff, and that's where we get more out. And collectively, it can be gassy, but it can have some condensates with it. And so that's why I say NGL prices, if those hold up, that means I start supporting liquids production too. So I think so, yes, that we shouldn't be talking about nearly as much as we are, but it's pervasive in the narrative right now, this whole peak shale. And I think we have to really, really be careful with that, because when people think of peaks, they think of a mountaintop and a cliff that comes down. And peak, people associate with decline. And decline shale is not realistic. Decline shale can happen if you pull back your rigs. I can decline output. I can also shut in my production, but I don't think it's smart to do that at $65 oil.
Thanks.
Yep, sorry.
Back to the slide you showed about the demand for the slices of make up the U.S. electricity supply.
Mhm.
Coal's going down, we're layering on renewables, natural gas, that slide. Over the next 10 years, what role and what slice do you see appearing from the emerging development of micro-nuclear reactors to power data centers and kind of on-site nuclear power?
Yeah, so it's a great question. And somebody asked me about nuclear today too. I like it. I like nuclear. You know, I can easily say I heart coal and I heart nuclear too. Nuclear though is expensive, and coal's not. And so that's only, the biggest difference is that we haven't figured out, everyone's really excited about small modular nuclear reactors. And I understand the excitement, I really do, because, from a military perspective, we're good at it. We use nuclear, we use it very efficiently, we don't have problems. But when it comes to actually putting it into the grid, we just suck at it. It gets really expensive. And so whenever we've tried to build one, it gets really expensive. So we've held nuclear pretty flat. Nuclear's that gray. And so nuclear is baseload dispatchable power, just like coal, just like nat gas. And you can actually look at Colorado's grid, and you can look at California's grid, and it's very similar. What's happened is they took out the baseload power, they took out off the nuclear in California. Why? I don't understand, but they are California. So they took off nuclear, and their electricity prices went up as they added wind and solar. So they took off that baseload power. And same thing in Colorado, as you take off the coal, we didn't have nuclear in Colorado, but we had the coal, they took off that and added the wind and solar. So the hope is that that's gonna grow, right? The nuclear piece of the pie is gonna grow, and you have lots of companies investing in it and a lot of excitement around it. You've seen stocks perform crazy, outperform because of a lot of hype. I would say your easiest way to do it is start adding to existing facilities, like existing nuclear places we have, and building onto them. The thinking that small modular is going to be the answer is I don't think that translates the same way into big is expensive. If the small is cheaper, maybe, but it still is all about the permits. It's still being able to build it, right? So if I can do it on places where it's easy, if I can start doing this up and then I can start scaling it, but we have to start somewhere. And so I'm very hesitant to say, prognosticate a guess of 10 years from now we'll have it, because we have to have some serious legislation done and some actually stuff built. So when I start seeing it get built, that's when you start, right? Once you start building it, and you see where the costs are at, and if you can bring those down, then that's a game changer. And those are real. So I think a lot of people have that. A lot of people would tell you that'll double in the next 10 years.
Does that squeeze the higher price, the wind and solar component of this? Does that squeeze that demand down, or is it just stack on top of the demand?
Well, if your power purchase agreements are incentivizing you to put in the cheap wind and solar, which it is, so you have to change that. If it's still doing that, then you'll keep adding this crappy wind and solar all day long, and you'll keep screwing the consumer. There has to be, the front end has to be addressed. You have to realize that wind and solar power, those are coming from China, and they're heavily subsidized. They're very cheap when you buy them. And so the power purchase agreement is incentivizing that. And then once they get into the grid, all bets are off, right? And so that's the problem, is that the way we're structuring this. So if that gets addressed, and either you ban the components from China, or you say it has to be cheap and reliable, wind and solar is done. Your intermittent power is done, and then you will incentivize nuclear. And so I think, the same reasons I'm making for nat gas and coal is for nuclear as well, is that if you're trying to incentivize the dispatchable baseload power, you need to address the fact that the incentives you're giving on these power purchase agreements and this intermittent power. If you say intermittent power doesn't win the day, that you will build it, and it will give the incentive to do it. And so we should be seeing more. Before nuclear, you would be seeing more combined cycle nat gas, but you actually should be seeing more. You would see more nuclear, and you probably would have a decade ago as well.
Coal's dying, and it's all air related, right? Is there any discussion about efforts and money being put back into bringing coal back?
Okay, so coal is, partly why coal is dying or was dying initially is because of nat gas, right? We have so much natural gas. but regulatory-wise, it was beat to, everybody went in like crazy, and so you couldn't. We've lifted, technically, I think the administration has lifted the ban on actually mining for coal now. Like, we effectively had a moratorium on building a new coal mine, or mining for coal. So the comeback, that's hard, because you would have to, again, these power purchase agreement, you have to change it. You have to be okay with having coal in the grid. So I think stemming the decline, like stopping no more decommissioning of coal, that's a minimum. That has to happen, or we're gonna have some serious issues. And absolutely, there's cases where I would say 100%. I would advocate building for coal, because I think in combination with natural gas, you do not have to use it all the time. We have very, very good clean technology where the emissions are not that, like, from an air quality standpoint, it's like, you don't want to have your whole nation powered on coal and have air quality issues, but you can have a little bit more coal, and you can have the benefits of both worlds, right? You can have all these benefits. In many ways, you can have your cake and eat it too. That's not what we're seeing, though, in terms of, are people going out and mining it? Are people, doing that? We're not seeing that, but we are seeing the pain stop, the bleeding stop, at least, where they're hopeful. If you go to a coal mine, you'll see, they're just like, they've been, think about the oil and gas industry needs to learn a lot of lessons from coal, because they've been beaten down for years, and they've done really well in terms of just surviving, in terms of, like, we have a handful of people working at a coal mine and we're running it, right? And so at the least that needs to stem, but I'm not seeing that completely translated. And I was asked today, is this administration talking about electricity? Is Chris Wright talking about electricity? I know he knows about it. You're not seeing that as public, right? But he is talking about it, right? He's at least talking about wind and solar. So I think they're doing it, but we will have to see some big steps on, like, hey, and a part of this is because it's all state level, right? On the state level, they're decommissioning the coal, so you're gonna have to see some changes there. But I think also recognition. Most people don't know this. Most people don't know why their electricity bills are going up, right? I'm pretty sure if they knew why, they'd be not happy. And they may want to say, hey, maybe don't decommission the coal, because I would like to add that nat gas, or I would like to have cheap power generation, or I would like to add more natural gas, but people want cheap power generation, and we need it for business. Sorry, you have had your hand up for.
No, we were talking about the nuclear component piece of it, and you touched on that.
Okay.
Maybe one more.
We got, okay.
How many, I'm sorry.
Rapid fire. This
Mine's
one's
a
good.
smidge off topic, so
Okay.
you don't have to come to me.
Okay, back there,
Yeah,
and then you pulled
just
it.
to piggyback off his
Yep.
comment, are there any regulatory opportunities for the existing coal manufacturers that were producing power? I know once you're idle for 2+ years, you start losing your environmental permits, and it's hard to get them back. So is there anything to help those guys and girls that are in the industry that were just recently shut down due to regulations to help them?
The power
get
plants?
back on? Yes.
So I think there, if you had one, I would be going to Washington and working on that. And there's some people I can tell you who to put you in touch with, because those should be able to turn them back on. I think there's a pathway to do that, because there's already a pathway of people that were going to shut them down. At the moment Trump got in office, Duke Energy said, if we don't have to shut them in, we're not going to, because it gives them massive flexibility, right? Because they have this baseload power, and now they're not scrambling to figure out what do we fill that with. So if people aren't shutting it down, I can guarantee the ones that they shut down, they could not shut it down, or they could turn it back on. Like that, that's possible.
Yeah, so I guess the question was, is the regulation willing to extend the timeline of the environmental permitting?
Well, the permitting reform is the next big thing that they're tackling in DC. So the permitting reform is the next big thing. So depending on what level it is, if it's a 10-year environmental impact statement, or if it's an EAS versus an ES, like those are things they're addressing. So I would guess that it's being addressed. I don't know for sure and haven't had that conversation, but it's a good question.
So bottom line,
Yep.
what would be your best guess on the 1, 3, and 5-year pricing for oil and natural gas?
People love to ask that question.
Just one absolute.
1, 3, and 5. No one's gonna have it. No one's gonna tell you, right? We didn't spend a ton of time on U.S. shale because I talked too much about everything else. But I just want to show this because I do spend a lot of time on granularly looking at U.S. shale and output, and looking at public and private operators. And we have a bunch of geopolitical risks that could easily give us a price spike. I think you should hedge at those price spikes, and but I don't think they can hold there. Right? The global economy is not ripping enough to hold up oil prices. So I think we have a lot of momentum in a range-bound scenario of 60 to 70. That's what we've been doing. We've been hanging out between 60 and 70. And unless something fundamentally shifts on the economy, like a material drag down with recession and seeing demand get hurt, we can go lower. And but we can also go, like, if we're sanctioning Russian crude and we're sanctioning, we implement sanctions on Iranian crude, which we're not doing right now. If we start doing that, prices can go higher. But the production that we have in the system right now, we don't need much to add a little bit more, right? You signal, you go back up to $75, and I think production comes with it, and I don't think we have a huge problem for supply and demand. But we are in a very tenuous, unique spot where we have soft-ish demand, flat and not going anywhere, and then we've got everybody's got a job, and the music's going, and we're playing musical chairs, and everyone's moving now. But if we start to see an uptick in unemployment, that's what starts impacting oil demand, right? And so we're just not seeing that yet. But the supply side, I am not worried about having enough supply. So if you tell me my economy is good, and we say the economy is good, that's fine. Let's set that aside. And then you say we'll take it to $75 oil. I tell you the production's coming with it. And so I don't see how a $75 oil is realistic. We could absolutely get there. We could have it, but I think we have to be careful of thinking we just have a lot of oil around the world. So whenever I hear these stories of like $85 oil, I'm like, okay, how much Russian production is coming back? How much of this is production? How much Guyana? Like, all this stuff is incrementally, going up. And none of those guys want to lose market share when they get it either. So I think you could, and I like to do scenarios for clients. And I like to get clients very comfortable in a range of scenarios. So I want you comfortable at 50, I want you comfortable at 40, because you make good decisions when you feel less, when you're comfortable in volatility. And we're not going to stay at 40. You can tip down there. You're going to spike back up. Could we go to 50? Have a scenario for that. 65, absolutely. We're there right now. And 75, that's very realistic.
Natural gas.
Oh, yeah, everybody has the next one. You can go to 4. I don't think it's going to stay, but I think you have to be careful at 4. People ask me today, would you hedge at 4? And I think you probably should start laying hedges. The momentum that we've seen at $3, I don't think people thought we'd get. We've really seen a lot of rebound in natural gas momentum at $3 an MCF. We're barely over 3 today, and people are like going to the moon. This is, how high can it go, and production just climbs with it. And last thing I just want to point out is this chart. This is your horizontal completions, public and private. That's total, like stacked up. That's your public, that's your private stacked up. The completions have dropped, yet output's been up. And so I am so bullish on production, and I'm bullish on this industry, but that has an impact to price, because we're very, very good. We're drilling less wells, prices on the decline, and yet we've maintained this output. That is a testament to this industry. It's a testament to the service sector, but it makes my vantage point on price different than a lot of my peers.
Thank you.
Thank you.
Yeah.